Welcome back. We're getting the numbers from Reliance Industries trickling in right now. The first number that we have on a consolidated basis is the net profit, which is down 24% compared to last quarter, coming in at 13,656 crores. This compares to a poll of 15,721 crores. So the first number that we have from Reliance Industries is below street expectations, and it is a fall of 24% quarter-on-quarter. Now, this doesn't come as much of a surprise because we do know that the petchem business, the oil-to-chemical business overall, has seen a sharp decline this time around. There's been a big fall in the refining margins as well, and sustained weakness for the petchem business, and all of this would have dragged down the overall numbers. We're awaiting more details, but that's the first number that we have on a consolidated basis. The revenues have also come through, which is about 2.3 lakh crores compared to 2.19 lakh crores last quarter. So in that sense, it's bang in line with expectations on the top line. The poll had thrown up 2.3 lakh crores itself. So that's a growth of around 5% that we're seeing sequentially. It's the margin picture which is not looking good for Reliance Industries. EBITDA margins have come in at 13.6% versus 17.3% last quarter. Just to put it into perspective, the margin expectation was 14%. And that's a steep fall that we're seeing in the EBITDA performance for Reliance Industries. 31,224 crores is the consolidated EBITDA. That compares to almost 38,000 crores. So not looking good. And we've discussed this, right, about how the oil to chemicals business, it's been a challenging environment. I mean, global gross refining margins have been under pressure, and that has dragged down the overall numbers.
Oh, yes. And that is exactly what has happened with the oil to chemicals business this time around. Remember, a couple of things that happened in the quarter. First of all, this was the first time when windfall taxes were levied on diesel and petrol. And that is one of the reasons why we did see a sharp impact on refining margins as well. So this time around, if we look at the revenues in the oil to chemicals business, they have declined. Actually, they are flat on a quarter-on-quarter basis. They've come in at 1.5 lakh crore rupees. However, there's a big decline in the EBITDA. So EBITDA has declined 40%, but that again is in line with what the street was working with. It has come in at 11,968 crore rupees. Now, what had happened here is windfall taxes, and there was a planned shutdown as well. And because of the way crude prices were very volatile, and that impacted the petchem business and the margins as well. So this is largely what the street was working with. On the flip side, if we look at the oil and gas business, that is something that is done well, even on a quarter-on-quarter basis. It was an expectation that on a quarter-on-quarter basis, oil and gas business will be flat, but there is an EBITDA increase of 16% to 3,171 crore rupees, leading to a margin expansion here, 82% versus 75.5% in the oil and gas business itself. So this despite the fact that a flattish performance was expected. So oil and gas business has really done well here. But yes, some weakness in the oil to chemicals business, but that's par for the course.
It's par for the course, but you know, it's a tale of two cities for Reliance. The driver of growth this time around was expected to be retail, and retail has driven the growth and how. In fact, it's a massive beat in the retail business this time around. The street was working with a 6% growth quarter-on-quarter. The number that Nomura was estimating was 62,140 crores on the retail top line. Guess what the company has reported? 65,000 crores in a quarter. That's the highest ever quarterly revenue that Reliance Retail has posted, 64,936 to be precise. And it has come at, you know, a higher margin as well, because footfalls are back, operating leverage is playing out, and as a result of which, the retail EBIT has grown 15% quarter-on-quarter. It's a number of 4,400 crores. The number that Nomura was working with this time around was 4,230 odd crores itself. So we've seen a margin improvement of 20 basis points quarter-on-quarter and 40 basis points year-on-year. How do the retail numbers stack up year-on-year? It's a 43% growth in the revenue and 51% jump in their operational performance. So retail is definitely doing its bit, driving the growth.
Absolutely. And the consumer-facing businesses, right, both retail and Jio are firing very well. We got Jio's numbers a while back as well. A good set of numbers, a revenue growth above 20% year-on-year for the third consecutive quarter, and the margins at over 50% for the third straight quarter as well. Just to put it into perspective now, the consumer-facing businesses, the share in the segment EBITDA has now risen to almost 50%. So 50% of their operational performance now comes from the consumer-facing businesses, both retail and Jio, and both are firing very well. It's the oil to chemicals business which is under pressure for Reliance Industries. But if you look at it, the oil and gas business, the EBIT has improved to 2,500 crores versus 2,089 crores. So a mixed bag coming in for for Reliance Industries. Sudeep Bandyopadhyay joins in. He's the Group Chairman of IndiTrade Capital. We have Prakash Diwan as well, who's joining in. Gentlemen, thanks for being with us on the show and happy Diwali to you. Prakash, I want to start with you. Your initial take on the numbers that have come through?
So, good evening, Sonia. So, yes, the numbers definitely seem to be reflecting that stress that's kind of building up on the O2C business. But, interestingly, the O2C business, in terms of revenue contribution, is significant. It's almost like 50% of the overall consolidated number. So, because that's such a big piece right now, and retail and telecom are yet to kind of become much more weighty in that sense, you will see that impact. But I think there's no taking away from the fact that retail has outshone most expectations, and it's just a kind of build up that is starting off a beginning of a big secular trend in terms of the festive season, and of course all their brand acceptance and acknowledgement that is there. So I think it's wonderful to see some of the new age businesses contribute, whereas the cyclical ones like O2C and parts of O2C, in fact, are the ones that probably have kind of been a bit soft, which is on expected lines. So the first reaction is there's nothing to complain about. I mean, the scale at which these numbers come, I have always been admiring the fact that they still manage to grow in certain parts every time, every quarter, year on year and quarter on quarter as well.
Okay, Sudeep Bandyopadhyay is also with us. Sudeep, the issue is that Reliance, the stock has already fallen about 14%, right, from the highs in April. And that perhaps was penciling in the weakness that we were expecting in the oil to chemicals business. Now that the numbers are out, how do you see the stock react to these earnings? Sudeep, there's some issue with your audio, so we'll try and fix that in a bit. We have Devin Choksi with us as well. Devin, thanks for being with us and season's greetings to you. What are your initial thoughts on Reliance's numbers?
Yeah, Sonia, thank you, and season greetings to you as well. I think on the face of it, the numbers I think are more or less on expected lines. Fortunately, I think the Geo business and the retail business numbers are actually, I think, more robust compared to, I think, the O2C part of the business. The numbers are subdued probably, I think, in O2C for the reasons best known to us. This particular quarter has an impact of the windfall tax as well, I think, in these numbers, as far as, I think, the refining business goes. And that could possibly be the reason for which I think the some amount of subduedness is being seen. At the same time, I think the numbers are also likely to be subdued. I think, though I have not seen the complete breakup on the petrochemical side of the business, I think there too, I guess, I think the numbers are likely to remain a little bit subdued because of the impact of the material raw material prices also at the same time. But overall, I think the numbers as expected, I think, and subdued numbers on OTC side, but consumer-facing businesses are definitely, I think, showing remarkably good amount of resilience, and I think the good set of numbers from that segment.
Okay, so in the auto chemicals business, the management has said that of course, the impact on EBITDA this time around was because of the planned shutdown that they had taken for primary and secondary units of their SEZ refinery, and that is one of the reasons why their utilization was also lower, and this is something that impacted their profits. Additionally, the windfall taxes that I was talking about is also that impacted their EBITDA this time around. They say that costs related to taxation this time around was close to 4,100 crore rupees, so that is a big impact. They also say that Reliance BP Mobility limited profitability continued because retail fuel prices, they were capped, and this despite the higher benchmark product prices. So this is something most of the refiners would be facing as well. And in terms of the petrochemicals business, they also talk about how their demand was good this time around, but the volatile crude prices, that is something that put pressure on spreads this time around. The feedstock prices were higher, and that is something which impacted margins across the value chain. Their polymer margins were lower. They were down anywhere between 6 to 32%. So this is the main reason why we are seeing this decline in the EBITDA, mostly pricing led, because a lot of it is commodity driven as well. And additionally, the windfall tax and the shutdown just added on to the weakness that we saw.
We have some more details coming in for the retail business as well, and these look extremely heartening because during the quarter, the company opened 795 stores. Remember, the first quarter, they had opened 792 stores. Last year, they opened about 2,500 stores. So basically, in just the last 6 quarters, the company has gone ahead and opened almost 4,000 stores, and the total physical stores are close to around 16,617. That's massive presence because, last quarter they also added 9.2 million square feet of retail space. With that, their overall retail space actually crosses the milestone of 50 million square feet of retail space. Footfalls. In the first quarter, the footfalls grew over pre-pandemic levels by about, 19% at 175 million. In the second quarter, it's increased by 5 million more. So the overall footfalls are close to around 180 million. And this compares with a 23% jump over the pre-COVID period. Digital commerce and new commerce business saw daily orders growing 53% and merchant base scaling 2 times over last year. And that is something that we saw in the first quarter as well. So that sustains. And all of this, remember, is in just the first half of this year. The second half of any retail business is usually the meteor half, where we see almost 60 to 65% of a retail company's revenues coming in. Prakash, your comment on the internals of the retail business from here?
So I think, Mangalam, I remember it was probably Q4 of the last financial year where, we saw a lot of the impetus on new brand inclusion. There was so many new brand association and engagements that Reliance Retail brought in while they were trying to stabilize their omni-channel on the regular grocery and staples market. Now, at that point in time, we could never imagine that they'll be able to scale up so rapidly in terms of where, they were at that point in time. And we probably gave it about a year, 18 months of sorts for some of the big milestones to be attained. And I think that's kind of happening much faster. That's happening almost like 2 or 3 quarters before expected, if you ask me. So most analysts have a run rate which was fairly aggressive or probably encouraging, if not aggressive. And that is something which I can see into this quarter's number could kind of, race much faster. And as you rightly said, we are actually staring at some of the best quarters ahead of us. This festive season is likely to be very strong on offline and online both. And they could see some footfall translate into big time sales as we see the December end numbers. So it's poised for a continuation of this scaling up, which is very critical in retail because the margin profile doesn't change drastically. It's only top line growth that you keep on continuing to strive for and set benchmarks with. So that's exactly what's happened. I think that's the area to look at going forward, if not the O2C and the telecom business, which seem to have matured already to a large extent.
Okay, just in the Jio business as well, right? A couple of internals have come through and they're looking quite good. The average revenue per user has gone up 1.2% quarter on quarter at 177.2, and that is the 6th consecutive quarter of an up move that we're seeing in the average revenue per user. That's led by a higher number of days in this quarter and a better subscriber mix as well. And we've all seen the data that came through from the TRAI in the month of August as well. The Reliance Jio has been gaining the highest amount of subscribers for the 5th consecutive month. So Devin Choksi, I wanted you to comment on this. Jio and retail are firing very well. Now Jio and retail together contribute about 50% to the consolidated EBITDA. Do you think the strength in these consumer-facing businesses is enough to offset the kind of slowdown that we're seeing in the oil to chemical segment?
So, Sonia, I think 2 points I would like to add here. One, I think in the retail segment particularly, the expected EBITDA margin would be somewhere around 8%. And the primary reason for that, I think, would be the kind of addition of premium brands that the company has done. And at the same time, I think some of their own brands which they have brought into different verticals. Now, with this particular addition of brands, which will over a period of time fructify, it could lead to an EBITDA margin of about 8%, which would be, I think, a sharp increase from current level of around 8.8%, which they have probably recorded. Given that kind of a situation, I would rather like to believe that I think on an annualized based turnover of somewhere around 250,000 crore plus, I think if this particular margin is achieved, I think this could be one star performer as far as I think the contribution to the EBITDA of the retailing business is concerned. The second aspect is on the Jio side. On the Jio side, I think we are counting currently the ARPU of about 177 odd. I would think that by the end of this financial year, I think we should be moving in the direction of somewhere around 185 to 187 rupees ARPU, and that could possibly be further resulting into higher amount of contribution. So both these divisions, consumer-facing divisions put together, I wouldn't be surprised. I think they would be in the vicinity of around 55 to 60% of overall EBITDA contribution of the company going forward in coming 2 or maybe 3 quarters from now.
Okay. All right, Devin. Take that point. We are also now joined by Probal Sen, Senior Energy Analyst at ICICI Securities. Probal, good evening. Thanks a lot for joining us. Well, weak performance from auto chemicals largely expected this time, but oil and gas business has done well. What is your first take, and what do you think would be the outlook going forward for both these businesses?
I think, yes, obviously the results, have disappointed a bit, even though, as you rightly mentioned, the OTC business performance was expected to be weak. But I think the extent of the weakness is a slight negative surprise, to be honest. Does seem that maybe the effect of the windfall taxes has been a bit more, or, the benchmark refining margins themselves have been a bit lower than what we were looking at. Oil and gas being strong is positive. I think retail has definitely surprised on the positive. And, to that extent, I think that's encouraging. I think from an outlook perspective, what has been good is that Europe is still holding up diesel demand, and therefore diesel cracks, contrary to every other product, are extremely strong even now at plus $40 level. And given that more than 40% of their product slate still comes from diesel, that is still actually propping up Reliance's GRMs compared to, let's say, the benchmark Singapore GRMs, which are languishing in the $2 to $4 range right now. I think that product tightness might continue, given that, in this winter, there is limited amount of additional gas available. So the gas oil to gas switching might continue to happen. So that can support, Reliance's GRMs to a certain extent. But the threat of economic recession, I'm not an economist, but from what we read and understand, petrochemical demand tends to be a proxy for overall economic growth. And therefore, if economic growth itself comes under question, then petchem spreads might actually see a further slowdown from current levels. Our understanding is integrated spreads are down about $60 QOQ to about $530 a ton for this quarter. And, in a trough level, they could probably go down by another 5% from these levels if demand continues to be, muted.
Take that point,
so from an OTC standpoint, it does look a little bit concerning, the outlook, at least in the near term.
All right. So the question then is that with some businesses not doing as well and some businesses doing extremely well, Abhijit Bora, Senior Analyst at Sharekhan, also joins in. Abhijit, the last word to you. What do you do on, Muhurta trading session when the stock opens posted numbers? Do you go ahead, put in a buy order, or do you wait for some more clarity before you look at Reliance once again?
Definitely, I think that results are good except for the O2C business or the standalone business, which were weaker than expected. But the more focus is on the Geo side, which has done well. The EBITDA is largely in line. Retail, the growth has been good, beating our estimate. So I think that the focus is more on consumer-centric businesses, which are performing well, and the standalone business is a largely volatile business. But the overall outlook, we think that is positive. So there may be some weakness because of higher than expected or lower than expected earnings in the O2C business. Overall, any weakness should be taken as the opportunity to buy this stock, as this segment will also stabilize going forward.
Okay, all right. Well, thanks for summarizing that for us, and thanks to our to all our guests for joining in. So in case you missed out on the numbers, Reliance Industries results are pretty much a mixed bag. Very strong consumer-facing businesses, good numbers from Reliance Jio, record quarterly revenues coming in for the retail business this time, and the consumer-facing businesses now contribute almost 49% of the overall EBITDA. There was weakness, of course, in the oil-to-chemicals business, but all in all, that was offset by a strong growth that we saw in the consumer-facing businesses for Reliance Industries. Thanks to all our guests for joining in, and with that, we will take a short commercial break and come back with lots more.